Bet big on deflation for big profits in 2022. We've been betting the opposite over the last year. In fact, we just took a massive 305% profit on ticker BOIL, a natural gas play. And unfortunately, I actually think BOIL could go up significantly higher, but the risk to reward ratio is nowhere near as good as it was in January when we were betting on inflation and energy. Top selling investment advisory is now up 33% year to date. We've given back a little bit of our profits, but all in all, extremely happy with that return, considering all the chaos that's been ensuing markets. What else could possibly go wrong in Biden's presidency? It's hard to think of anything else, but I'm sure something will. We're up 233% 2021 and as high as 48% year-to-date return in 2022. So we have given up a good bit of that. We'll talk about why, and more importantly, why we haven't changed our positions. We're very confident to stay put and let these positions ride. So let's talk about what we're expecting for the remainder of 2022. Buy these 4 stocks now before it's too late. Pick one as a play that energy prices will go higher and higher and higher as long as there's a conflict in Europe. This is why we're at war. Russia doesn't want nuclear weapons on their border. So what do you know? We are now at war. The big news is Finland's trying to join NATO, and now Russia's cutting off natural gas. Not enough to pull the trigger on that BOIL. We're considering re-entering BOIL. We got Rand Paul blocking a $40 billion spending package, which would almost ensure BOIL goes significantly higher and escalates the war. So watching that. Looks like it's going to get passed. That seems both parties are ready for war, even at the cost of starving people and having extremely high energy inflation. Here's the Russian ruble, the only currency outperforming the dollar. Their exports are up, while the total volume of oil sold has reduced. The dramatic increase in the cost has definitely been very beneficial. So on the energy side, if we think that Russia just wants to slow play this, which maybe is what they want to do, as long as possible, the NRGU is more attractive because this can just keep oil steady at these high prices. And the big US oil and gas companies just rack in massive profits. So that is probably a more surefire bet. If they're going to start poking the bear too much and put Russia in a corner, and perhaps that's what could be coming down the pipeline with $40 billion in aid if it's passed, assuming it actually goes to Ukraine. It's pretty skeptical that much of that money would actually end up with the war effort. But if Putin's going to strike back, he's much more inclined to cut off natural gas. Not as much money for Russia in that, and it's an easy way to cause significant pain to Germany, France, and most of Europe. So maybe we do a combo trade next week. In general, though, I'm worried that energy costs could fall off a cliff at any moment. We'll take a look at that. Pick 2 is a play that interest rates are about to collapse due to monumental fall in GDP from China's lockdown, which is now on day 48 and looks like it's going to get worse. We've got energy costs, tightening financial conditions. We've got interest rates at levels that will collapse demand for borrowing. So all sorts of problems. And here's a look. We're past the band that typically creates problems. I'm actually quite surprised we don't have a greater financial crisis on our hands with interest rates at this level. So there's a lot of ways the interest rates go down. It could be good news or bad news, but my safest bet to make you guys a lot of money over the next 12 to 24 months is US Treasuries. We love it at this level, and we've been out of them since the lockdown in QE. So we almost got the very, very best print on the TLT for our clients. Held it a little too long. The bond market actually collapsed in that lockdown, which was crazy. But that was last time we made a lot of money on bonds, and we waited to get to that 3% on the long end of the US Treasury curve. We're there. And so we are a buyer. We could have good or bad reasons for interest rates to go lower from here. It's probably your safest bet over the next 12 to 24 months to make a ton of money. Okay, this is really problematic. China's not sending stuff to the US, so it's going to create some more short-term inflation, and they remain locked down. So from China's front, this is helping reduce energy costs and causing financial pain to the US in terms of more inflation on trying to get goods and services to the States. So how long can China stay locked down? Not that long. Probably another 30 days max before they're going to have massive, massive problems locally with domestic riots are already starting to ensue. Okay, in this chart, we got the credit impulse, 12 months from Bloomberg. Then we got import-export prices in the US. This is indicating that we're going to have a deflationary shock coming through global economies. We can see it in all sorts of data. Used car prices falling, shipping rates falling, and lumber futures falling. Oil's starting to creep back up. We know the catalyst driving that. But in general, just about everything is slowing down. This is due to a lack of stimulus that caused all this extreme inflation. Now, into the future, we can see China is starting to push credit back up. So get ready for the whipsaw action. Here's the latest inflationary data. It's pretty much concentrated in energy. Okay, and we know what the cause of that is. Everything else is cooling off rapidly. So transportation, of course, and then anything to do with electricity, energy, or fuel, driving that inflation print very hot relatively on one of the two inflations that we focus on. Here's another look at that exact same data. Everything is really cooling off except for energy costs. Now, pick three, it's down to 15,000% return today in 5 years. I expect this to go up at least 400% in the next 3. The asset is Ethereum. And all things considered, Bitcoin and Ethereum are holding up quite fantastic. We had a bond market crash that's never happened in history. It's a sigma 3. That's like a 1 in a billion chance of happening. I'm shocked we're not at 1,000 based on the market crash in bonds that we just went through. Looks like that's over. I do not anticipate bonds creating volatility to the downside from here. Then we had a $40 billion market cap from Terra Luna, wiped off the earth in 3 days. People are on Reddit talking about suicides. I had a friend locally who lost $1 million. I mean, one day Luna's at 100, next day it's at $1. I spoke to him 2 days ago. I used to pay him for advice, technical aspects of crypto. He was taking out loans to buy Luna at $1, and I said, "Wow, I don't know." And then the next morning it was at a penny, and what a chaotic move. So a lot of chicanery happening in crypto. All that said, with a bond market crash, with the Fed tightening and interest rates rising this quickly, with one of the larger cryptocurrency projects that was so well trusted getting blown up, I think cryptocurrency is doing fantastic. And now we're about to have the bond market on our side, if I'm correct, with the deflation coming in. So I think this in bonds are where I would bet big. My only concern is maybe another 30 to 60 days of energy disruptions due to Europe, with the war hawks pushing harder and harder to put more money out there. But it's not so clear whether or not either side wants to escalate the war or just keep it grinding along. Grinding along not necessarily will create a big jump in energy costs. Now here's a look at Bitcoin over time, the volatility you've had to live through. You could have turned something like a penny into $30,000 if you bought at the very beginning and survived all the hacks and everything. And you had to live through extreme volatility. Trying to pick tops and bottoms, extremely difficult. The big winners in this space have essentially bought and held, and that's it. And that's really the strategy we have for cryptocurrencies. Unless I were to believe bonds were going to collapse from here, I think we're most likely at a bottom in cryptocurrencies and a beautiful future ahead over the next 12 to 24 months, correlated with lower yields incoming. Now, ever since we went into this hyper printing mode at the US, the Bitcoin has become hyper correlated to the NASDAQ. Throughout much of its history, though, it was much less correlated. So we'll see if this trend continues. But in general, I would also anticipate relatively good returns ahead for the NASDAQ, again, assuming we can fix supply chains. Now, Bitcoin is not going to be disrupted by Chinese lockdowns and Russian-Ukrainian neon disruptions, which is critical for chips. Now, again, Bitcoin does need those chips, but Ethereum does not when it switches to proof of stake. So we'll see how this correlation remains. Here's a look at returns for Bitcoin. Your biggest return was in 2010. In general, this has had some pretty nice returns most of the years it's been in existence. And the dollar has actually gone up this entire 12-year period. If we're predicting a weaker dollar, which Ray Dalio, Jeffrey Gundlach, a lot of greats are predicting over the next decade, your path to that $1 million Bitcoin, or at least $250,000 Bitcoin, might be a lot sooner than you anticipate, because we've been, again, fighting a dollar going up this entire time. Here's another neat chart for crypto. Don't look at the highs, look at the yearly lows. $4, $13, 306. 2015, it actually went lower for, I think that's the only time in history it's done that. It went to 190. That's actually when I sold my my Dodge Challenger and went pretty big on crypto, and kind of got a lot of startup capital for my company. But you can see it keeps going up. 360, 779, 32, 37, 33.99, 5,000, and the low this year was 28,723. Okay, next play is our stock crash insurance, UVXY. This went up 1,000% in the 2020 crash. Now, interesting, in the recent volatility, the VIX has been not doing its job. And the reason why I've come to learn is that investors are programmed now to buy the dip. So in this market volatility, rather than everyone rush to put options, which is the normal tendency, they've been massively buying call options. And so this has not been skewing the VIX to go up. The VIX goes up when the put options outweigh the call options, which tends to happen on the way down. And so we're also looking at record low liquidity. Again, typically we get to this level, it bottoms out and goes back up. So in general, I think we have very little to do with the portfolio. Sit back, make some great returns. And I've been hesitant to put back on the energy hedge because a lot of the data we're going to look at indicates it could fall if there's any type of de-escalation with Russia. And unfortunately, it does not look like that is in the cards anytime soon, especially if we're going to push a $40 billion spending package through. So step one, we're going to buy 75 shares of UVXY. This is, again, for a $10,000 portfolio. Here's a look at that chart. It's been swinging up and down, left and right all year. This has been a very difficult market. Step two, this is our highest conviction trade. Treasuries, TMF, ticker 160. The rate of change is never been seen before. We're above the secular trend, and we're trading at a real cheap price. So TMF gives you 3 times leverage on the 20-year treasury. This is the worst crash in bonds in history, not only in the percent decline, but also the length of the decline. This is due to inflation really outpacing and getting ahead of the curve way beyond what the central bankers were expecting and pricing into the federal funds rate. Step three, if we think yields are going lower and we're not going to have a liquidity crisis, which again looks like we're at the bottom of the drying up of liquidity, cryptocurrencies should thrive. We've got Japan in yield curve control. We've got China printing money aggressively. So we're recommending 188 shares of ETHE, currently trading 30% below its par value. So a great buy to get exposure to Ethereum. And there's that ticker ETHE. Pick four protects your account against a stock market crash. You made 1,000% gain in 2020. That slide we just looked at is what you should have seen right here. So looks like some of my slides got out of order. I'll fix that next Monday. But in general, we got Japan printing. They're doing yield curve control, causing their currency to devalue. China is now printing to protect their real estate market and economy from another lockdown, which I did not anticipate. And you can see their currency is devaluing. So the second, energy prices fall. Expect the dollar to fall and bond yields to collapse. And so trying to time that is difficult, but we can see we're at a very high DXY. This makes the ability for foreigners to pay down US denominated debt extremely difficult, makes our bonds unattractive. So there's a lot of reasons to get that dollar down to support the US's egregious debt necessity. Now, when the dollar goes down, that's when we're going to expect cryptocurrencies to really shoot up and bond yields. So that's what we're anticipating. The trade alert we've been waiting on is BOIL or NRGU. Been just carefully watching this. We got to realize natural gas at $8 is absolutely absurd. Oil above 100 is absurd. And the second there's a de-escalation, all the speculation could really fade away and we could see a pretty nasty shock in energy. So we made a lot of money betting on this for quite some time. Unfortunately, the fundamental reason to be long energy remains intact. So unless the whole world gets exhausted from the high energy costs or Russia backs down, unfortunately, this could go up higher and it's a dangerous trade. So we got in very low price, wrote it up, made a ton of money. I'm more interested in the reversal of this play to make our clients a lot of money over the next 24 months. And the only risk I see to that play, which is betting on yields falling and deflation, is another energy shock. And so the warmongers are relentless. They are just relentless. So we'll see, but we just got to realize the reward now is potentially go to 200. I would anticipate at the max. And the risk is for this to fall back to the 40s to 60 level. So we're going to be very careful with BOIL. That's why I continue to sit on my hands and observe. So right now, the BOIL position should be in cash. That's what your trade alert says. And you should just be buying your UVXY, your treasuries, and your Ethereum. So you've got a completely deflationary portfolio with nothing that will do well if the inflation goes higher. And again, I've been carefully monitoring this to try to make a good play for us. Perhaps NRGU will be a safer bet with a smaller BOIL position. We may get that play back on next week because it's quite likely the Republicans and Democrats team up and keep this war going. The bond market was on the verge of crashing the stock market. Perhaps it still is. We're getting a little bit of a rebound. So TLT 120 was a red line. We're at 116. We've seen it go as low as 112. I highly anticipate these yields fall, and over the course of time, TLT goes to a new high. A lot to explain in that, but that's how governments grow debt. They have to drive yields lower. They've got all sorts of shenanigans planned with central CBD coins. So they want to give you money, bypass the banking system, and make that money disappear if you don't spend it with universal basic income. This is how they expect they can get interest rates to zero or negative and keep the debt growing as they try to switch to this clean energy economy by 2050 is the big globalist dream. So we'll see if that all plays out. Here's a look at oil coiling up as high as 126, I think was our high. And we've seen this just coiling up. It's ready to go much lower or higher, depending on what happens with the war. And I think it's really that simple. If it just stays as it is, it looks like Russia's finding plenty of buyers and ways to sneak their products to the market. So I think in general, the risk is to the downside unless the war aggressively escalates, which is very hard to predict. Now here's a longer term look at oil. And again, it has traded at these prices before. but not for very long periods of time because it's destructive of demand. Now, if the conflict were to end, I would go really heavy in ticker FNGU because it's going to free up the supply chains. Most likely China magically ends their lockdowns, gets back to work, and all the tech companies have a really good setup, lower yields, and semiconductors are back in action. So that would be the war ends trade. If the war is going to continue, we want to play energy to the breaking point and then flip to treasuries and UVXY and expect a crash. Here's FNGU, just a massive dump from 50 to 10, as low as 7, I think. And today bouncing around a bit of a bid. We got a big, perhaps short covering today. So I'm being a little cautious to say the bottom's absolutely in, but we got the SPY up 2%, the NASDAQ up 3.4. But it's not the first time we've seen a big bounce in stocks, only to wake up the next day with a big, massive crash in our hands. Here's an interesting data table looking at how many -3% days there were in a year. Most of the years there's none. Okay, so this is pretty unusual. 2020 we had 16 such days. 2008, 23. 2022 this was at 3 when this was created on 5/9. I think we've had 2 or 3 more now. 2002 had 7. 1987 we got to go way back to I believe that was Black Monday. We had 6 on that year. And then to get worse, you got to go to the Great Depression. 50 in 1932, just absolute chaos. 1929 to 1934 is a really nasty period. And then leading into World War II, we had some pretty bad years. Outside of that, it's not normal to see this type of volatility. Here's another chart looking at 5% corrections since the start of the year, and looking at what the forward return is. So we'll analyze this more next time. Now, in general macro view, last time we had a period where China was printing money. Now we can throw Japan into that mix, and the US was tightening. You might think that was a bad time for crypto, but actually the dollar fell, especially towards the end of 2017, and Bitcoin ripped up 4,400% return. The main thing to note here is the DXY index towards the end of 2017 fell 10%. So I think that's going to be the real trigger for all us crypto fans out there to get that big gain, because we've been fighting a rising dollar. Now, if you want the sell alerts and the buy alerts, watch our webinar every Monday, Wednesday, Friday, and don't miss a trade alert. If you're on a free trial, call Dean to upgrade at 505-322-7515. Now let me see what commentary we have. Yeah, we do get, free trial guest says, do we get a recording? Yep, so the same link that brought you live, after the webinar ends, give it about 30 minutes and it'll redirect to here. Yeah, Stephen, you're asking me about the leverage ETFs every webinar. I don't think that will change my my look at the markets. We'll just simply switch from leverage products to the deleverage products. Someone's asking if Coinbase is going to go bankrupt. I don't think so. No, absolutely not. Okay, great. So let's go to our news feed and then we'll look at some data. Yeah, so if they ban the leverage products, we'll go to the stocks. So UPRO would be SPY, Triple Q would be QQQ, EDC would be EEM. Could it create some volatility? Sure, but I kind of doubt that's going to really happen. We'll see. We'll see if they take those away. Okay, so we still got we got more and more of the surrounding states around Russia trying to join NATO now, and Russia's threatening they'll attack you if you do, with Finland being the latest story. So again, this is going to keep these energy costs elevated. For Boyle, we actually need the prices to go up to make money. And in my opinion, that would only happen if Russia is using it as a weapon, which they very well could. NRGU, we likely can make a lot of money just if this war is a long, slow one and oil just stays range bound. So that's the way I look at those two products in terms of how they're going to benefit our portfolio. And so unfortunately, it looks like the war is not ending anytime soon. We've got the RSI pretty low on stocks, not as low as it could go, and certainly on bonds. So very rare to have a relative buy signal on both at the exact same time. So we could very likely be at a bottom here. The Michigan consumer sentiment came in super low last time it's done this. It's consistently been right in front of a recession. I'm not seeing the data to argue for a recession in the near term, maybe 6 to 12 months out. I think people are just sick of the inflation making them depressed. This guy, I'll leave the commentary off on him. Global wheat crop likely to fall for the first time in 4 years. We've got massive wheat stuck in Ukraine. I think Russia has seized it and using it as a weapon now as well. So food costs certainly are going to be really high for the next 2 years, I'd expect. Energy costs could come down a lot quicker, but the food costs, of course, take a lot longer when you have to spend a whole season growing food. A little bit of a hiccup on the Twitter deal. We'll see what happens with that. The Twitter deal could have more implications towards politics and being able to control narratives. So that might be interesting as we approach midterms. We'll see what we read on that. Rand Paul blocked the $40 billion deal. I'm not sure how long he can block it for, saying that he wants oversight on the spending. I think there's a block that says unlimited spending for the CIA, just outrageous. Obviously, this benefits all the war contractors, or defense contractors. Everybody's ponying up to pay for gas in rubles. We had 391,260 crypto traders liquidated in the latest fiasco with losses of 1.25 billion. But the market cap of Luna was 40 billion. Now it's 0. So, or it's like a 50 million or something insane. Here is a critique of why it wouldn't work. So they're trying to back their stable coin with Bitcoin. And the problem with that is if Bitcoin goes down too fast and there's a big withdrawal from the stable coin, it creates systemic selling that makes it worse. And so that's exactly what happened. Somebody got, there's lots of rumors about who it was. In general, this blew up. Someone was able to get a massive amount of money parked in their stable coin and simultaneously build a massive short on Luna. And so when they pulled out the money from the stable coin, it caused on the Luna side, and reportedly this person made like $800 million in 3 days. Now what's interesting, we then saw Tether coin start to get attacked, but it seems to have recovered. And so while Tether's potentially a bigger risk than obviously than Luna, that risk has been well known the entire time and somehow never seems to falter. So we'll see if more volatility, but it did break its peg for a little bit, and that's when we got even more volatility in crypto. So I've been watching that quite carefully. Sticky part of the inflation is the wages are rising, the rent is rising, absolutely. But with interest rates this high, let's expect a slowdown and cool off in housing. So I don't think that will be necessarily as bad as it could be if interest rates hadn't risen to this level. Stablecoins could soon have to park cash at the Fed, according to JP Morgan. And that would probably be a good thing for the space. Crypto losses now equal 1.7 trillion. The 2007 subprime mortgage market was 1.3 trillion. This guy's a super bear. I'm not so sure. SoftBank Visions Fund posted a record $27 billion loss as tech stocks plummet. Another big hedge fund gave up 10 years of gains in 3 months from the tech blow up. So a lot of people were just all in on tech and got really hurt this year. Now this would be a real interesting twist that we've never seen yet. Zero Hedge says it will be awkward when the Fed is forced to resume quantitative easing, even as it keeps hiking rates. So that would be almost comical if they did that. Right now, they're planning the opposite, quantitative tightening plus rate hikes, and actually have begun that process. This guy's a big thread about the risk on Tether. They're very opaque. They're out of Hong Kong. Shady people ran it. And that's something you have to understand is a certain risk when you're investing in cryptocurrencies. Tether will not reveal its assets. So that again, obviously drives a lot of suspicion of the market. Okay, so that's the key headlines. I think the biggest news front will be the 40 billion headed towards Ukraine to keep the war going. All right, here's a look at bonds over the last 40 years. You can see they go down over time. This is how governments grow debt larger. If that trend doesn't continue, governments have big problems. And so do markets. So if this doesn't go down, we've got huge problems on our hand. I believe we're at the upward bound and probably stabilize here and then crash lower. And it could be for good reasons, which would mean supply chains open up, energy costs go down, you get a healthy push lower in yields, or alternatively, the economy snaps due to supply chains being broken for too long, energy costs not going down, demand destruction, recession, and then you get your yields lower. But almost under no condition do I see yields sustaining higher interest rates than this without creating problems and then quickly after going lower. So if there's one safe place to put money at this point, I would be betting on treasuries. But again, the reason they might go up could be good or bad for risk assets like Ethereum or the NASDAQ. And that's assuming Ethereum will stay tied to the hip of NASDAQ at this low market cap it currently has. I think for cryptocurrencies to break away from the correlation to the stock market, they're going to have to grow in size by about 10 times. So about a $10 trillion market cap, and it may become its own ecosystem of itself. Here's a TLT. Again, same chart. You can see in general, after sharp crashes, you get nice sharp rebounds. And that's what we're anticipating. We're on the cusp of. Same thing for the housing market. It's the whole bond market. It all works the same way. They're all extremely correlated. So I'd expect the dollar goes lower, interest rates go lower by the year end. And that's where we're going to make the next big money with the risk to reward ratio being in our favor. When we got into Boyle and NRGU, we definitely had volatility, but at least the risk reward ratio was to the extreme upside. That's why I'm so cautious to jump into it now, because the downside could be 3 to 4 times greater than the upside, even though it's a critical hedge for us in the coming month. Here's the 2-year and 10-year spread. So it inverted for a split second, jumped back up. This has been indicative, predictive of recessions 12 to 16 months down the road. But a lot of people point out this one did not give us that signal. And so the 3-month over the 10-year did not invert and still looks quite healthy with the spread. So I'm not so sure we're have that that signal that everybody's counting on to predict a recession in 6 months. A lot of people think we're imminently going to have a recession by year end, where it looks like maybe next year at the earliest. Here's your yield curve, still slumped, totally wrong shape. We'll see if the Fed can fix that up. We're looking at a 50 basis point rate hike at the next meeting, low chance of a 75. So I think the bond market's happy with that. The VIX didn't give us the return we would have hoped in this recent volatility. Everybody's been buying call options, betting the market will go back up. And so we didn't get that big pump on the VIX. Reverse repo sitting at 1.8 trillion. That's a lot of money that could flood the market at some point, still stuck in the Fed, borrowing their debt. The Dr. Copper gold to silver ratio, gold to copper ratio is predicting lower yields. So let's see it. We've been waiting for lower yields for months, and we're ready for that change in dynamic. Here's NRGU and Boyle. So this is where we made a lot of money this year in Boyle. Could it go higher? Yes, if Putin cuts off gas to Europe, it'll absolutely go higher. How much higher? Well, we'll see. But $8 is what it's at in the US, or just shy of that by about 30 cents. Normally, in a normal world, it was $2. So you got to understand the significant risk in Boyle. NRGU could keep climbing if we just stay steady. So I'm carefully examining which position to enter next week and what ratio. We'll probably have a little bit of both until we see some sort of sign that the war is going to reverse and at least pull back sanctions and get these energy costs lower. Lumber futures telling us beware of a energy collapse. May of last year it predicted that and began to rebound. So it's a great leading indicator of inflation, and it's warning us. It is warning us, and that's one reason why I've been worried about that. Now here's DXY just going straight up 2021. Absolutely insane move. So for a year and a half, we've been fighting a rising dollar. So just wait for that puppy to fall. It's going to need to. Otherwise, emerging markets are going to collapse. We're going to have bigger problems on our hand. In general, a lot of the people I really look up to, and notably, they run the biggest money funds in the world. They're all predicting a weaker dollar over the next decade. So if you're a crypto fan, that's what you want to hear. And so cryptocurrencies were born when the dollar bottomed out right here. So that's what takes us to extreme new highs, is a falling dollar over a long stretch of time. And I do think we are very close to that moment in time. And most likely the catalyst will be, again, getting energy costs back down. Now here's some currencies devaluing against the US dollar, the Japanese yen and the Chinese yuan. So the money printing is happening, and that's another sign for bullish times ahead for cryptocurrencies. Now, if you're denominated in those countries, cryptocurrency crash isn't nearly as bad. That's really against the dollar where we can see this extreme pain. We're fans of Bitcoin for the safe growth strategy, Ethereum for our high risk, and our private equity fund has been buying the crash in Polygon, which has been painful in the short term. But when Polygon turns around, it can have extreme returns. It's highly concentrated in a very small group of people. It just raised $500 million. It's got big money behind it. And it had an 18,000% return when Ethereum had 1,000. So it outperformed it by 18 times. And that's where we think you can get hyper growth in an emerging technology. Okay, this chart perhaps is the most concerning. So yellow line are interest rates going up. NRGU is the oil going up, or the top 10 oil and gas companies' valuations. The NASDAQ fell, and that's what we'd expect. The outlier here is the banks should be loving higher interest rates, and they're not. So there's a warning sign that these interest rates are not sustainable and are destructive to the economy. Now the data is still showing rapid credit growth, so pretty interesting to see this disparity between the return of NRGU and banks. Now, if I zoom out a little bit, you can see those two had been quite correlated until about right here. And then they began to go opposite direction. It's telling us these energy costs are going to be very problematic for the economy, as well as interest rates, and need to be brought down. Here's emerging markets against the S&P 500 over that period where the dollar fell, and you get that extreme return in emerging markets. We have exposure to this with EDC. Now, we're not going to get a great outperformance in emerging markets if China is completely locked down. So that China just keeps doing crazy act after crazy act for well over a year now. How much pain can their economy sustain before they start focusing on growth? We will see. Tencent, Alibaba, and Taiwan Semiconductors, 3 leaders in the EEM ETF. And we're starting to see some signs of life with Alibaba and Tencent. But every time I say that, something else happens and they give it right back. So this has been a very horrific chart. If I zoom out enough, I think we can see up to a 80% decline in Alibaba, China's champion e-commerce website. But typically, when you get a leading tech company in China that dominates, a 50 to 60% discount is a good buying opportunity, and that's where we're at right now. Here's a longer term chart of Europe with ticker EFOs, gives you Japan and Europe stocks. The main strategy in the safe growth is to be highly diversified and to not put all your eggs in one basket. So we do have a smaller position in Europe with EFO, trades at a very cheap relative price to US stocks. The war had caused significant pain. It bounced back up and then took another dive lower. So at this point, we're still long, have not changed that position. Now, here's a look at the alternative energy products: uranium, copper miners, rare earth metals, typically used for batteries for RMX, and copper miners. And then uranium, of course, would be for nuclear energy. And we've seen a pullback in all 3 of these. This would be indicating deflation coming in. We're not in gold or silver, just watching it at this point. And we're starting to see a pretty considerable sell-off in both of these assets. Now, I was predicting this would fall. This is US core inflation. It does not include food or energy, which of course is the main problem we're facing. But sure enough, it fell. So it tells us our prediction is correct. And the only thing that's going to hold us back at this point will be the war and China locking itself down. I don't think China can lock itself down for more than another 30 to 60 days maximum. So from that front, pretty confident the supply chains will reopen in China. The war, though, I'm not so sure how long that's going to last. So the $40 billion going over there is quite worrisome. So we're paying close attention to that as best we can. But good news, even with the big shock, the inflation's falling. So this seems to be what we want and what we predicted. So next, we want to see those bond yields materialize into lower yields to really make us confident in this deflation play for the next 12 to 24 months. Even if the war continues, I'm not so sure we won't still see deflation. Really, for me to think the inflation problem is going to abrupt, we need a big escalation and severe disruption of energy. At this point, looks like everybody's finding workarounds, and there's really downward pressure on energy costs the longer this goes on. Okay, the jobs keep growing. One reason I'm not in gold, I see more jobs open than there's people willing to work. So I'm not seeing a stagflation. We've got labor force participation rate going up faster than I had anticipated. We've got bank credit growing at the fastest pace month over month since the lockdowns. And we've got the biggest jump in consumer credit. Economy's red hot. I don't see any reason to think we're about to have crashing earnings from corporations anytime soon. US spending just hit a new record high. trade balance hit a new record, so we're just buying as much stuff as we can get our bloody hands on at the fastest pace in history. So no reason to think the recession's happening anytime soon. Sure, house sales fell 10%, but look at that. It's in an upward trend, and there's not a lot of inventory currently. The scariest data is that the banks are falling with rising rates. That doesn't make sense. We got China in a lockdown, which doesn't make a whole lot of sense. Their PMI is now in the 30s, which is very scary. But in general, their exports are still in an upward trend. Did they slow down? Sure, but they're not crashing. Same thing with the exports. So everything looks pretty reasonable, and I don't anticipate us dramatically changing strategy anytime soon. Okay, we're about to jump into the exact asset allocation per strategy. And if you're on a free trial on YouTube, you're not going to see the end. You need to call Dean to upgrade at 505-322-7515. So people asking if deflation is bad for, yeah, no. So I think it's a big miscalculation that cryptocurrencies are an inflation hedge. I actually say it's the opposite. So I look at, if I think there's inflation, I want to bet on interest rates rising, and I want to bet on oil going up. So I look at NRGU and BOIL as an inflation hedge, and I look at Ethereum as a deflation hedge, betting that interest rates fall. So actually the exact opposite.